The value of the U.S. dollar against other currencies dropped about 11% in the first half of 2025. That is the biggest decline in more than 50 years. According to Morgan Stanley, the dollar is expected to lose another 10% by the end of 2026. The slump means the end of a 15-year bull cycle for the dollar. At the start of the year, though, that was not expected to be the case. Trump's focus on tax cuts and deregulation was supposed to boost growth and keep the U.S. equity market ahead of the curve. However, tariffs have now become Trump's trump card. It's become the primary agenda of the White House and hence grew the fears of inflation and rising debts over the potential negative consequences for U.S. government bonds and the currency. In the last 6 months, several currencies have grown against the dollar. The Swiss franc has seen double-digit gains. The value of gold has shot up and is expected to go up further. This, analysts say, happens when investors rush to gold as a safe haven asset and dump the dollar. In April, Trump unveiled tariffs on imports from several countries. What it caused was a sell-off in U.S. financial assets. Reportedly, $5 trillion was erased from the value of the S&P 500 index of shares in the 3 days after Liberation Day, the day Trump announced tariffs. What it does is that it makes investors wary of holding dollar assets.
Tariff tsunami hit from Trump, and now you're starting to see rubber meet the road in terms of what some of these tariffs actually look like. And you combine that with some softer economic news, the market is a little nervous about this combo 1-2 punch.
The end result is that Trump's unpredictable policies have slowed U.S. growth prospects and dented the demand for the U.S. dollar. The dollar is the anchor in global trade. According to the Atlantic Council, 54% of world exports in 2023 were in dollars. The U.S. dollar's prospects depend on its markets and judiciary. Given that Trump has taken the world on a roller coaster ride, investors have continued to trim their positions, and the dollar's value has subsequently taken a hit.
We're at a GDP growth now in the first half of 2025, about 1.2%. My view is that that is kind of flirting with stall speed for the U.S. economy, and that some of the things that are really kind of foundational to economic growth, like consumption, like private investment, have sharply decelerated.
There's an upside to the U.S. dollar taking a dive. The pro-Trump camp argues that the dollar's dive places the United States in a better position when it comes to exports. A strong dollar makes U.S. exports expensive and imports cheaper, widening the trade deficit. Trump has repeatedly criticized the Federal Reserve for keeping interest rates too high and boosting the dollar's strength.
Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
The dollar dropped on Friday after Federal Reserve Chair Powell pointed to a possible rate cut at the central bank's September meeting. The stocks soared, but what it means is that the dollar assets are losing their shine. The euro gained 1.06% to 1.1728 and reached 1.1742, the highest since July 28th. Against the Japanese yen, the dollar weakened 1.08% to 147.77. What does it mean for India? A weaker dollar, relative to the rupee, increases the purchasing power of U.S. buyers for Indian goods and services. For a country like India, where exports account for around 21% of GDP, that is significant. Trump's actions have been topsy-turvy, and it only raises the question, is it the beginning of the end of dollar hegemony?